Net Wealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Net Wealth's. The guests' organisation and Net Wealth have an arrangement for their financial products to be available for investment through the Net Wealth platforms, and Net Wealth may receive fees from the guest. More information about Net Wealth can be found on our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
Welcome to the Net Wealth Portfolio Construction Podcast, brought to you by the Net Wealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Net Wealth Portfolio Construction Podcast series. My name is Paul O'Connor and I'm Head of Investment Management and Research. Today we welcome Rory Shapiro from AMP Capital, who is a member of the AMP Capital Infrastructure Equity Team. AMP Capital has 3 decades of experience in infrastructure asset class and has invested significantly in resources within the global infrastructure business, including personnel with operational and transactional experience. AMP Capital's infrastructure team manages $21 billion in direct equity infrastructure investments as of 31 December 2020 across the key markets in Australia and New Zealand, Europe and North America. Rory is an Associate Director in AMP Capital's infrastructure equity team and has been with the manager for 6 years. Rory works across the full life cycle of infrastructure investment, participating in portfolio management, deal origination, and asset management. He's the portfolio manager of an institutional infrastructure fund and the assistant fund manager for the AMP Capital Core Infrastructure Fund, which provides retail investors with access to unlisted infrastructure. Direct or unlisted infrastructure is a mature asset class used by many investors, and Australia has a long history investing in and managing infrastructure assets. Infrastructure has long been viewed as a lower volatile investment with similar characteristics to direct property, given it provides regular income with some potential for capital growth. However, the last 12 months must have challenged some infrastructure assets due to their reliance on the consumer, such as toll roads. So I will be interested to hear Rory's views on what areas have been the most and least affected by the COVID-induced economic slowdown. Also, given the ongoing debate about whether the recent rise in inflation is short-term due to supply constraints or structural, I will be interested to discuss how a structural rise in inflation leading on to a rise in interest rates could impact on infrastructure assets. So perhaps to commence, Rory, can you explain to the listeners how you came to be managing direct infrastructure assets with AMP Capital?
Yeah, sure. So my background in terms of what I studied was I did an engineering degree and a finance degree, and through that, I was able to work on some large projects in my final year of uni, and one of those was essentially a giant project in Saudi Arabia, and I was working on that based in the Houston office of a big chemical company, and so from that, I got a really good feel of working on projects and found it quite exciting. So when the time came, I found infrastructure to be attractive because obviously in infrastructure investment, using that finance background and that finance knowledge, but also you're working on acquiring or managing big complex projects in the form of infrastructure. So it's always interesting, always lots to think about and lots to do, and keeps me on my toes.
Interesting double major at university there, Rory, doing both engineering and finance there, but I can appreciate how that would give you a good appreciation of the actual asset and then the actual funding of that asset there too. So I can see how those two skill sets would come together to be working on infrastructure. Infrastructure plays an important role in many institutional investors' portfolios and is increasingly popular amongst retail investors. Given some listeners may not be familiar with the asset class, do you mind explaining what kind of assets AMP Capital's private infrastructure funds invest in and the sort of benefits that infrastructure can more broadly play in a diversified portfolio?
Yeah, sure. So when we look at infrastructure, our high level definition is that an infrastructure asset is an asset that provides or facilitates the provision of essential services that drive economic growth and underpin the day-to-day operations of society. Now, obviously, that's a really broad definition, and what we tend to do is, or a good way to look at it is to split it into sectors. And there's really four key sectors that we look at. So the first is your transport style infrastructure. So airports, roads, seaports, and even to a certain extent logistics. And then the next category that we look at is energy and utilities. So anything from electricity transmission to gas transmission to water utilities. The third that we look at is communications infrastructure. So that often involves things like telecommunication towers, broadcast towers, and data centers. And then the final category that we look at is social infrastructure and what we call private-public partnerships. And so those are usually arrangements with the government where essentially you build, operate a facility for a government counterparty, and in return they pay you a fixed quarterly payment. So those tend to have quite secure cash flow streams. So really the benefits across infrastructure assets really are derived from the fact that they're providing an essential service. They often have natural monopolies or contractual monopolies, and therefore the risk of, I suppose, substitution and competition can be lower. And also, typically speaking, the impact of an economic downturn can be lower for an infrastructure asset when compared to some other types of assets. So really what that tends to play out into is quite stable cash flows, and also lower levels of volatility in cash flows, links to inflation at times, diversification in a portfolio, because often the drivers that would say drive a standard stock might not be driving an infrastructure asset's cash flows, and that goes in hand with the fact that infrastructure tends to have a lower correlation with other asset classes. And so you bundle up all those benefits together, and that tends to be a reason why a lot of institutional investors have significant exposures to infrastructure within their portfolios.
Yeah, well, I guess those four subsectors of infrastructure would have different risk and return characteristics. And what I mean by that is that some would be more in tune and linked to the economic cycle, maybe around transport, and yet others that are more social infrastructure would not have any link to the economic cycle. And so therein, you probably get some level of diversification within those underlying subsectors. But I guess that is where they can play a role that is not correlated to the typical growth assets in a portfolio, and hence will have obviously diversification benefits when blended with your typical equities and property and the other type of growth assets that investors use in portfolios. So it certainly strikes me that it can play a very key role, and particularly in toning volatility and producing more reliable income, I guess, through a portfolio. Whilst listed infrastructure provides investors with better liquidity, does the broader equity market volatility associated with listed assets actually reduce the appeal from a portfolio construction perspective? And are listed infrastructure assets typically more mature when compared to unlisted?
listed infrastructure and private infrastructure both invest in the same types of underlying assets. So theoretically, over the long term, you'd expect them to have a similar risk and return profile. But sort of as you noted, the way that you access the underlying investment does have an impact on the risks and benefits that you face. So for listed infrastructure, you're able to build a diversified portfolio in a short amount of time, and that's largely due to the fact that the securities are very liquid. You don't necessarily have to buy large portions. But then on the I suppose the downside, or some of the detractors from that, are that first of all, you're subject to market volatility, and potentially the impact of speculation or other factors on equity values. And then the other downside is that as an investor in a listed infrastructure stock, you don't necessarily have any influence or control over that asset, other than potentially turning up at the AGM and saying a few words. Whereas with unlisted infrastructure, because these assets are held long term by larger investors, usually they're valued less frequently by independent valuers, and so they're not valued every day. But the policy tends to be that they're valued when there's a significant change in circumstances that could lead to a change in the value of the asset, or secondly, once every 6 months at least. And what happens is the independent valuer, which is usually a Big Four accounting firm or something similar, will take the corporate model for that asset, take a long-term view, and then provide a valuation range. And as a result, with that long-term view, I think the value does a better job of looking through the short term to what the long-term proposition for the asset is. And often that makes sense if you've got a long-term time horizon in your investment. I think the second advantage is control and the ability to influence. So typically when you buy an unlisted infrastructure asset, you're buying a significant stake, and at a minimum, we aim to have a seat at the board, if not majority control. And that allows us to work with management and harness our experience to drive outcomes in the asset. So to give you an example, we across our different funds and investors, we manage investments in about 4 or 5 different airports. We're able to take learnings and apply them to the investment. And that's not something that really, as an investor, you're able to do in many listed investments. And so that's a key benefit that we see for unlisted infrastructure. In terms of some of the limitations, it tends to be the reverse of listed infrastructure. So obviously unlisted infrastructure is not as liquid. A sale process or an acquisition process can take anywhere from 3 to 6 months or more. And so as a result, it takes a longer time to build a portfolio and also to sell the portfolio. Additionally, you need to be able to have significant amount of capital to meaningfully invest in the space, and that's because it's largely been an area that institutional investors have played in. So the kind of equity stakes that are up for sale, are in the tens and hundreds of millions, or if not billions. The place that we tend to like to play in is what we call the mid-market, which is investments of equity sizes of around $100 million to $1 billion.
I guess as you're making your comments there, Rory, I'm thinking to myself that it must be a lot more capital intensive or resource intensive, or both resource and capital intensive, investing in direct infrastructure, but you can have a bigger influence on the outcome and the success of that asset, as opposed to the listed market. Whereas you'd mentioned, I guess you're a bit more of a passive investor. in that essence there too. So I think it's an important consideration for the listeners too when they're considering what type of infrastructure exposure they'd like in their portfolio. That listed will obviously give them better liquidity, but perhaps the direct infrastructure asset class will give them a smoother return through the cycle. And I guess more of an impact that active management can have on managing those assets there. So it's interesting, the observations I think that you were making there, Rory.
Yeah, and I think the other thing to note is that it's not always one or the other decision. Our retail fund that we manage, the core infrastructure fund, we that portfolio is a split of 50% unlisted infrastructure and 50% listed infrastructure and cash, or at least that's the allocation we target. And we find that the correlation between listed infrastructure and unlisted infrastructure is, I suppose, low enough that there's actually quite good diversification benefits from having the two in the same portfolio. So it's something that fund is definitely benefited from, that split allocation.
Yeah, and I guess also the great benefit of a structure like that is that having liquidity means that it can be readily offered by superannuation trustees without the concerns of offering illiquid assets and then the obligations on a trustee to pay a rollover within a prescribed period. So, yeah, I think it certainly makes a lot of sense to be blending both the listed and the unlisted bits together there. 2020 was an unprecedented year due to COVID-19, of course. So how did infrastructure investments perform, and what areas of infrastructure were the most impacted by the economic slowdown?
Yeah, so it's been an interesting one, and into 2021 as well. Really, if you look at it in the four categories that I outlined earlier, as you'd expect, the hardest hit asset or sector has been the transport, and that's been largely due to travel restrictions. So
that makes sense.
Yeah, that's right. So globally, the through fare through airports has been significantly reduced, and a pandemic is quite unique in that it impacts all airports all over the world pretty much. So usually what you'd see is, there might be a impact somewhere in the world and it wouldn't transfer to another airport, but really we've seen obviously a reduction in passenger numbers globally. We saw quick recoveries using Melbourne Airport, which is one of our investments as an example. We saw recoveries, within a year or two to the previous passenger levels in the wake of SARS, the GFC, when Ansett went into administration. So this pandemic's been really unique in terms of global air travel, in that we've seen a broad impact, and so that's been where I think the most pain has been felt in infrastructure assets. Obviously, all the assets that we manage, and I think in the broader infrastructure investment industry, have revised forecasts downwards, and so that's within the valuation of the assets now. That outlook, which has been impacted by COVID. I mean, typically what we're seeing is that domestic passengers will recover first, and that we expect them to recover to 2019 levels around 2023, and that international passenger numbers will obviously ramp up more slowly, and we expect them to recover to 2019 levels in around 2027. So that's already in the valuation, and I think that's the positive thing to take from that is that to the extent that with vaccine rollouts and learning to live with COVID, to the extent that the recovery in air traffic exceeds that, then there'll be upside to those asset values. I think in terms of what's been the least impacted is probably two sectors. So the first is the social and public-private infrastructure sector, which public-private partnership sector, which I discussed earlier. And that's essentially because those projects tend to have what's called availability payments. And that just means that as long as you meet key performance indicators in your contract with the counterparty, which is usually a government, in those assets, then you get a fixed payment. So as a result, it's not really impacted by passenger numbers or economic growth or anything like that. And so as a result, those assets have performed to expectation. Where assets have actually performed on the upside is digital infrastructure, so things like data centers and fiber optic networks and mobile towers. And that's just because I think we were always going this way as a society where there was more, I guess, digital interaction. And I think that COVID has accelerated that. So as a result, data usage is going up. A lot of workplaces are, I think at least my office at the moment, especially with the lockdown, and primary way of communicating is Microsoft Teams. So obviously that has a follow-on impact on the demand for that kind of infrastructure. So as a result, those assets are probably doing better than they are doing better than they were pre-COVID, or at least a big portion of them are. So it's really been a diverse impact through the different sectors.
Yeah, and I guess, again, to the earlier comments we were making there, Rory, it's sort of not surprising there that transport sector, being and including airports, is more linked to the economic cycle and the movement of people, whereas that whole social infrastructure is not related to the economic cycle or any impact really that COVID-19's had. So again, in my mind, I'm thinking about the various diversification benefits of blending all of these sub-asset classes of infrastructure together in a portfolio. So looking ahead, we're still facing a fair bit of uncertainty in the near term, obviously due to COVID. So what's your outlook for the infrastructure sector? You'd mentioned before about digital infrastructure and the growth of those assets. Is there still a good investment opportunity there, or are they quite high in terms of valuations? And where are you looking and thinking at the moment?
Yeah, sure. So I think that those assets, they still do have a strong growth profile, but they are higher up on the risk return spectrum. And so I think within all the sectors, there's always going to be opportunities that are more attractive than others. And our approach is really to just build a diversified portfolio of those sectors. I think that on the transport infrastructure side, as I mentioned, to the extent that we as a society learn to live with COVID more rapidly than expected, I think there could be a surprise on the upside there. And obviously, I think that there's still going to be a demand for travel. I think international travel's ingrained within a lot of Western societies. So, we're looking in that space and just trying to understand, what's happening with COVID vaccine passports and different vaccines and things like that. So that'll be an interesting space to watch. I think that through COVID, the lower risk social and PPP side of things has sort of proved its worth. And so we still see those as an important part of a portfolio, generating stable yields through different kinds of economic impacts. And then I think for digital, it's always something we're looking at, and it's just a matter of understanding the specific risks of each project because they also are so different. But it's definitely a space that we're looking at.
So, where are the emerging opportunities in infrastructure, and is the investment universe changing as it's growing, and as the number of investment opportunities increase there? And I guess what I mean by that across those underlying subsectors of infrastructure.
Yeah, sure. So I think there's a few different types of opportunities. So I think investment opportunities are often generated by government privatizations. So globally, government balance sheets are quite strained, and so governments still need to be delivering on new infrastructure and improving infrastructure. And a model that has been really effective in New South Wales in particular is what's called asset recycling. So selling older infrastructure assets to a private investor, like the poles and wires or toll roads in Sydney and New South Wales, and then using that money to invest in new infrastructure. So that opens up in investment opportunities. I think that's more sort of, at least in Australia, maybe a medium term to long term thing. Liberal governments tend to be more in favour of privatisation than Labor. I think the other emerging opportunity is digital infrastructure. So before cars, obviously there wasn't a need for toll roads to the same extent as there was. Horses and carts still needed roads, but it increased the infrastructure need, and so it's the same with digital infrastructure. And so it's definitely with the need for data centers and fiber networks. Those opportunities continue to emerge. With data centers, what's really important and what we look for, and we don't have any invested in any in Australia, but we are invested globally, is the stability and the length of the contracts, the counterparties for the data center. Are they reliable? And the switching costs. So it can be surprisingly expensive to move all your servers from one data center to another. So high switching costs can really add to, I guess, the monopolistic characteristics of a data center business. So that's an area that we continue to look at.
Yeah, well, I guess the opportunity set across infrastructure develops and changes as society and our behaviours change, and as you've articulated with technology or infrastructure assets. But I think also pertinent was the point you made around that the more stretched government balance sheets are, the more they are going to want to partner with the private sector on building out infrastructure there. So I guess there's increasing opportunity that we'll probably see over the next 5 to 10 years as a result of those pressures. Now, I guess moving on to an issue that's being debated quite a bit across the finance industry, and that's inflation. So can you maybe make some comments around how infrastructure assets perform when inflation is rising, and can they provide investors with some protection, given many infrastructure asset income streams are linked to inflation?
Yeah, so that's definitely our view. A material portion of the investments or assets that we look at and hold have revenue linkages to inflation, which is obviously a positive thing to have in a rising inflation interest rate, in a rising inflation environment. Also, there's, I guess, a more implicit link in some of our assets. So assets that are GDP linked often have an implicit link to inflation, with the rationale that in normal circumstances, when you see a rising inflation, it's often driven by increased demand and increased economic growth, which tend to drive volumes through assets like airports and toll roads and things like that. Obviously, it's important to think about inflation when building a portfolio, because you don't want to lose the purchasing power of your money. So definitely we look at the inflation linkages when we're considering investing in an asset.
It really could be a double-edged sword, though, I guess, Rory, in terms of if we do see inflation rising, that will obviously have an impact on interest rates and rising interest rates. And given a lot of infrastructure assets are a combination of debt and equity, how could a rising interest rate impact on infrastructure assets?
Yeah, so there's a few different lenses that you really need to look at that through. So the first is cost of debt. So infrastructure assets tend to have more stable cash flows when compared to a lot of other asset classes. As a result, they do tend to have relatively higher gearing. And so if interest rates rise, then all other things being equal, that would lead to a increase in the cost of debt for those businesses. Now, the approach that we take in our investments is we look to hedge out interest rate risk in the long term. And so what this means is that we essentially enter into interest rate swaps where we're swapping the floating leg for a fixed leg. And so as a result, that tends to minimize a large portion of the risk for cost of debt. So I guess that's a positive thing. The next, so you wouldn't expect it to be, I guess, infrastructure assets to be impacted that much. The only area where they would be is assets where there's a large growth component, which will be funded by debt. And that's because you can't hedge future debt that you haven't taken on yet. And then the other important, I suppose, lens to look at it is through the way assets are valued. So infrastructure assets are valued with what's called a discounted cash flow model. And essentially all that means is that you forecast out the cash flows into the future, and then you discount those cash flows. Now, often what's used to discount those cash flows is the capital asset pricing model. And I won't go into the details on that, but one of the key inputs is the risk-free rate, which is basically long-term interest rates. So if long-term interest rates go up, the discount rate goes up, and the value of the assets will come down because you're discounting the cash flows by more. And that's all things being equal. So there's probably two things to note on this for unlisted infrastructure. First of all, the independent valuers of unlisted infrastructure, as I discussed, take a long-term view. And so as a result, there is an expectation that interest rates over the long term will revert closer to the long-term average. And so as a result, they've essentially built in buffers to their discount rates. And what that means is that just because interest rates go up by a certain amount doesn't mean the discount rates of their assets will automatically increase and therefore decrease value. So there's that buffer there, which we see as a positive thing. And then the second thing is that a lot of our assets are linked to GDP. So airports, toll roads, all those sorts of assets. And as a result, in a rising interest rate environment, similar to the rising inflation environment, you'd expect to see economic growth. And so as a result, you would expect a offsetting benefit to revenues of the business. So I think the way that we look at it is if you just look at an increase in interest rates in isolation for cost of debt and also for the valuation of assets, it can look like quite a negative picture. But if you account for the mitigation that we have in terms of hedging debt and also the approach taken to the valuation of our assets, we wouldn't expect the impact to be too material.
So, Rory, there's been a lot of infrastructure spending announced by governments globally as part of fiscal stimulus policies. So what does this mean for infrastructure investors?
Yeah, sure. So I think really what it'll mean is that there should be more supply of infrastructure opportunities for investment in the future, largely, as I mentioned, due to asset recycling. So government's likely to sell old infrastructure in order to fund new infrastructure. So that'll be add more supply, which is a good thing as an investor because it means one, there's more opportunities for you to invest in, and two, it sort of moderates the competition around the finite universe of opportunities that all investors have.
So I guess another prominent emerging theme we're seeing everywhere across investment markets is ESG. Do you guys consider ESG factors as part of your investment approach? And if so, how do you actually do this?
Yeah, sure. So ESG is something that we've incorporated into our investment approach, at least for the whole time I've been at AMP Capital, so at least 6.5 years, and it goes back much further than that. The underlying rationale for that is that we believe that assets that have a strong approach to ESG also tend to perform well on a financial basis. So that's makes it a good incentive to really have strong ESG credentials. And so there's a few different ways we do it. First way is that each year we do a survey, which is essentially benchmarks our ESG monitoring and management and reporting against our peers, and we seek to, I guess, improve our score and our ranking every year by looking at how we can improve our approach to ESG. So I think at the high level, that like we're always reviewing how we're doing compared to our peers and how we can do better. At a more granular level, we do it across all our activities. So when we're looking at buying an asset, when we go to get investment approval from our investment committees, we have a section dedicated to ESG, and we do our due diligence on ESG. So whether there's factors which are potentially opportunities or whether there's risks, and essentially we approach that the same way we would any other opportunity or risk. We either price it in to our bid, or we would walk away from the opportunity because the risk is unacceptable. And then in the assets that we manage, we essentially participate at the board level to ensure that there's a review of ESG considerations, that there's sufficient reporting from management on things like energy usage, that projects which are more energy efficient are considered. So, in some of our airports, that might be a trigen facility, or installing LED lights in a car park, or it really crosses the full spectrum. So we're just really active in looking for opportunities to apply that ESG lens.
Rory, thank you very much for the time you've spent on the NetWealth Portfolio Construction podcast this morning. And I guess your comments and your thoughts and your insights into infrastructure, I've certainly found fascinating there, and I'm sure that will be of a lot of benefit to the listeners there. And I think particularly then back to the listener and thinking about how infrastructure can be used in a portfolio, I think some of the really relevant comments there around the listed versus the unlisted infrastructure assets and how they have slightly different risk and return characteristics. And then also the fact of the different subsectors of the infrastructure asset class and some of the growth opportunities in digital infrastructure and some of the challenges that transport infrastructure has faced in recent times. So it's been really valuable, and I thank you for joining us this morning, Rory.
Thanks a lot. Thanks for your time.
Good to have you. And to the listener, thank you very much again for joining us on the NetWealth podcast series, and I look forward to joining you on the next instalment. Have a great day, everyone.
Thanks for listening to this episode of the NetWealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.